A historic week for the Fed. It bought corporate bond ETFs for the first time, which caught a lot of attention. And it was another brutal week for the job market, which saw millions of more people file for unemployment benefits. Rick Rieder's here. He is BlackRock's chief investment officer of global fixed income. He's also the head of the BlackRock global allocation team. And Rick, I want to start with this news that we're just hearing about and kind of just get your thoughts on some of these potential risks that are out there, the idea of more tension with China, what that could mean for the economy and for the markets.
Becky, I think you hit the nail on the head. I mean, this is, by the way, the markets have a whole series of uncertainties that are going to play out over the next few months. But the China trade one is going to be maybe not as big as it was a year or so ago, but it is going to be real. And by the way, when you look at the equity market, you look at how commerce works today. You think about semiconductors. You look at the percentage. I think semiconductors is one of the top 2 or 3, if not the biggest, in terms of market cap of the equity market now. So when you do something that has an impact on that sector, then it really impacts the market. So this is something, by the way, when you think about the China trade discussion, you think about the China relationship discussion broadly, this is one of the issues that has broad bipartisan support. And my sense is this is going to be more and more of what the markets are going to focus on, particularly up until the election, as we get closer to the election.
Broad bipartisan support in terms of wanting to play tougher with China?
Yeah, I should have clarified that. Yeah, I mean, there is, different senses of how pernicious that has to be. But no doubt there is a bipartisan, one of the few things, there is real bipartisan support that we need to be or should be as a country tougher. And things like this with regard to Huawei become a galvanizing point of support in terms of both parties. So, yeah, it is something that we're going to focus on. We'll create volatility into the election for sure, if not longer.
Andrew has asked the question of a lot of people over the last couple of weeks, just the idea, if we do have more tension with China, what does that mean when so much of our supply chain is based there? Not just for electronics, but also things like personal protective equipment, some of the things pharmaceuticals. Yeah,
totally. No, it is a big deal. I mean, the intertwined nature. I mean, we see this a lot when we talk about the asset markets. There's been a lot of discussion about investments in Chinese assets, while the Chinese are tremendously large holders of U.S. assets as well. These interlinkages in medical supplies, in technology broadly, are significant, and how that plays out. By the way, none of these are an easy answer, and I think the more aggressive that the U.S. is, it's hard to see that you won't get some sort of retribution on the other side. So it's going to be an important dynamic. But like I say, I hope at the end of the day, there's a pragmatic approach, because some of these things, like you say, pharmaceuticals, et cetera, are pretty ingrained and very hard, where we're going to move down a road of being more localized in supply chains across the board. It's very hard to abrogate existing supply chains today for things like pharmaceuticals that take years before you can actually get those drugs into what is a mature state.
Rick, before we got the news about Huawei, I was kind of thinking about what I wanted to talk with you about today. And just thinking about risk assessment and how much tougher your job has gotten on that front these days. Like, how many possible outcomes or potential outcomes are you trying to think through these days? How disparate are those outcomes? And what can the Fed do to alleviate any of those things? How do you kind of put that all together at this point?
Well, it starts at about 4 a.m. every day at my desk, Becky, and then goes till about 7 p.m. And then Asia gets going. Listen, I think one of the things that's happening, by the way, why this is such an interesting market, an exciting market in a bunch of different ways, is the opportunity set. We're going to go through, and this is not just where we sit in May. This is going to be a dynamic going forward. The dispersion around asset classes, the dispersion around companies, the regional, where growth is in Europe, where growth is in the emerging markets, and trying to get, we do a tremendous amount with analytics and data assimilation to try and see, we study credit card data around the world, trying to understand where are growth patterns, where is consumption taking place. Anyway, it's a fascinating time to be in markets, but you can't, we've lived, I think people underestimate, for 10 years, we lived in a reasonably stable economic environment with some Brexit, et cetera, that was thrown in along the way. But it was pretty stable, and then taking it right on that trend line, back to the trend line if you got off the trend line. It's not going to be, this virus is going to be with us for a very long time, and including the last segment you guys were talking about, when you think about transportation, et cetera. So what you're going to have is more dispersion, technology evolution. It's going to, so I think it's a fascinating time to be a market. It's a fascinating time to try and generate return, relative to indices, et cetera. But boy, it is time intensive. Even if you have tremendous data and analytics, it's still incredibly time intensive.
Well, speaking of some of that data, what's the answer when you're looking at the credit card data from around the globe? Where are you finding growth?
So, some of the things are no surprise. I mean, when you look at technology, look at the evolution of digital businesses, and it's not just the traditional businesses that you would think, my gosh, it looks like Amazon's doing well and Google's doing well, et cetera. But then you get into some of the companies that have employed digitization and have employed technology into their businesses, and even the companies like the Walmarts, the Targets, companies like that have done phenomenal jobs with regard to logistics, the UPSs, et cetera. Those are some things that we're watching pretty closely, and then regionally. Listen, we think that the U.S. is going to grow. We think China is going to grow, and the China's impressive, and the data we study around across the board in terms of we're looking at China is impressive. It's not a V shape, but boy, it's not far from it either. And but gosh, and then we look at Europe, and we don't see a catalyzing. We don't see it in any of the data that we look at. Some green shoots back to where we were in a couple of places, but not really. And in emerging markets, we think it's a longer slog, particularly in places like Brazil, Argentina. It's a longer slog, and that'll take time.
Okay, so China went into this first, so you would expect them to emerge first. You think the difference in Europe, where you're not seeing sort of the emergence of green shoots or really growth on the way back, do you think that's because they went into it later and we may still see that? Or do you think it's because another issue we were talking about earlier this morning with Eunice Yoon in Beijing? I mean, China has taken some really severe measures, things like monitoring people on their cell phones, demanding that if you're going to fly in to Beijing, you're going to be sent into quarantine for 14 days. And if you don't have a house there, they'll send you to Mongolia, no joke, Mongolia, to a hotel that they've got there. None of those things are going to happen in the United States. I doubt they're going to happen in Europe, because in a free and democratic society, those are huge impingements on freedom. And if that's the case, again, do you think that is eventually going to come here and to Europe? Or do you think that because they are able to put those more stringent factors that they're going to see a sharper bounce back?
So Becca, I mean, there are a bunch of issues, a bunch of things that you brought up there, all very fair. One of them is, like you say, the measures that China took were very aggressive. And, by the way, it's easier in China when you have one region and you're managed, as it were, from one single point of attack. When you talk about Europe, you're talking about a disparate set of policies and countries in terms of their forms of commerce. That makes it harder. Secondly, by the way, I do think you're going to see more of those testing, more aggressive testing, et cetera. I think, as you talked about in the last segment, you'll see in the U.S. So those issues are there. But listen, I also think you have to think about the starting point and context. China is a country that grows, that's maturing, but still growing at 6% and change, depending on how you measure it. U.S. is growing at a point, we were growing at, real GDP that was 3 to 4%, for high, but the run rate is real GDP, we think, is closer to 2-ish%. Europe is starting from a point where there's no catalyst for growth. The commerce is different. I know I've said on this show a bunch of times, the ECB just dropping interest rates and keeping rates negative is never going to get there. And you don't have the catalyzing growth influences. You think about, as we just talked about, the digitization of the U.S. economy. You don't have those engines of growth. So you're trying to stimulate without significant fiscal stimulus. You're trying to stimulate an economy that's just going to be difficult, let alone the tourism effect, let alone how travel impacts the European continent, which is known for significant amounts of travel throughout it and into and out of.